Welcome, and thanks for taking the time to watch this webisode on becoming investor ready. It's an unfortunate fact that most business owners are not what we call investor ready when they embark on the process of raising capital from external providers, be they angel investors, venture capital, private equity, or any professional investor for that matter. But what do we mean when we talk about being investor ready? Well, we're talking about making sure the business is in the best possible shape prior to engaging with an investor. In simple terms, making sure you are match fit. If you're not investor ready, there are likely only two outcomes from trying to raise capital. You end up with a poor deal, or more likely, no deal at all. This is the case for any business in any industry, but unfortunately it's probably more the case for the tourism industry. Why do I say that? Well, in recent years, the Australian tourism industry hasn't been a happy stomping ground for investors, many of whom have seen poor returns. This, coupled with the fact that businesses looking to raise capital in the tourism industry are competing with businesses in other industries and other geographies, means you need to get it right and get it right first time. Okay then, so what are some of the things that businesses operating in the tourism industry can do to get themselves investor ready? The first thing is to make sure the historical financial reporting is up to scratch. Poor quality financial reporting scares the hell out of investors and can often single-handedly kill a deal, regardless of its merits otherwise. Okay, so what do we mean by being up to scratch then? The business should produce monthly, not quarterly or annual, profit and loss statements, balance sheets, and cash flows. The frequency is important for a number of reasons, not least because a lot can happen to the financial performance of a business in the space of a few months if the results are not known. So investors expect to see monthly financial reporting as a minimum. Most businesses will report a profit and loss statement and a balance sheet. Many, however, do not report historical cash flows. As the adage goes, revenues for vanity, profits for sanity, cash for reality. Businesses live and die by the cash they make, and investors will want to understand what the cash generation has been historically. If your accounts are not audited, consider getting them done. Whilst there's an associated cost, it will provide a level of comfort to an investor evaluating an opportunity and will aid with the due diligence process further down the track. Depending upon the type of business you operate within the industry, there will also be an expectation that you track and report your key performance indicators, or KPIs, on a monthly basis. So for a hotel operator, for example, that might be occupancy rates or revenue per available room, or RevPAR. Okay, so moving on to strategy. Notwithstanding everything we've just said about the importance of historical financial reporting, investors buy the future, not the past. Therefore, it's critical that you have a business plan or a strategy document that articulates where you want the business to be in 3 to 5 years' time, and importantly, how you're going to get there. Now, clearly, this is good business practice anyway, but it will seriously erode your credibility with an investor if you do not have a robust strategy in place when they come to assess the opportunity. Following on from this is the requirement to have a financial model. By financial model, we mean an integrated profit and loss, balance sheet, and cash flow forecast going out for at least 3 years. The financial model represents the financial output from your strategy. Now, virtually all capital raisings will require a model, as it's necessary to help investors understand the type of capital structure the business can sustain over the investment period. It's also necessary as it will inform the financial returns an investor will get out of the investment, and ultimately whether it's something they want to pursue. It therefore makes sense for a business owner to be prepared and to build a financial model for themselves and to understand its outputs prior to engaging with an investor. Now, it's no secret that good governance has risen up the corporate agenda in Australia over the last 10 years. Whilst this has mainly impacted listed corporates, financial investors expect to see a decent standard of governance in the businesses into which they invest. As a minimum, this should include clearly defined roles for management and the board, and a framework for reporting and monitoring business objectives on a regular basis. You might also want to consider adding a non-executive board member. Now this can assist with good governance and, depending upon their background, can also add credibility to the overall opportunity. Last, but by no means least, is management. It's often said that venture capital or private equity would rather invest in an average business with a great management team than a great business and an average management team. What this means for you as a business owner is that you need to identify and fill any gaps in your management team before you engage with investors. After that, you need to ensure that management, especially those that are critical to the business, are aligned with your strategic objectives and are incentivized accordingly. Now, whilst this might all sound like a lot of work and overwhelming, it will be time well spent. You often only get one shot at raising capital, so you need to get it right to avoid disappointment. The secret is to start planning and preparing well in advance of when you expect to engage with investors. This has been Webisode 1 of 5 in the series. We hope it's been helpful for you, and don't forget to download the additional information based on this topic located on the Webisode's landing page. For further information, please refer to the contact details on your screen.